Most beginner option sellers ask one question: how much premium can I collect? But experienced accountants ask a different question: what happens if I'm wrong? That single shift in perspective can completely change your long-term investing results. Today, we are going to look at option selling through the eyes of a chartered accountant. To a gambler, options are a way to make quick predictions about where the market is going. But to an accountant, options are a tool for structured risk management and capital allocation. Accountants don't focus on high-yield promises, they evaluate probability and downside exposure. They ask, is this trade sustainable? What is the actual probability of capital impairment? If a strategy cannot survive a severe market downturn, it is not a viable business model. Your primary goal should always be preserving the balance sheet, not chasing temporary revenue. When you protect your downside, the upside often takes care of itself. The first pillar of professional risk management is strict, non-negotiable position sizing. No single trade should ever represent more than 1 to 2% of your total capital. This ensures that even a worst-case scenario will not cause permanent damage to your portfolio. The second pillar is asset quality. Only sell options on high-quality businesses. Ask yourself, would I be comfortable owning this stock at the strike price if assigned? The third pillar is clarity. Never enter a trade whose structure you do not fully understand. You must understand how implied volatility and time decay affect your position's value. Always define your exit criteria and adjustment points before the trade is even active. This brings us to a major trap, focusing solely on high option premium. High premium is not free money. It is a market signal of high uncertainty and risk. When implied volatility surges, the potential downside expands faster than the premium. To understand this, let's look at option selling from a business perspective. Think of your collected premium as revenue and potential losses as liabilities. Your portfolio's cash balance is the buffer that protects you from sudden liability increases. A well-run business does not maximize revenue by taking on toxic liabilities. Similarly, a disciplined options portfolio focuses on sustainable, high-probability net income. Every trade should be evaluated as a business unit that must earn a safe return on capital. Let's review the most common risk management mistakes made by retail traders. The first is concentration risk, followed closely by the overusing of margin and leverage. The second is chasing high implied volatility on businesses you know nothing about. And third, entering a trade without a clear pre-planned adjustment or exit strategy. To avoid these traps, apply a simple checklist before every single trade and see what. First, am I completely comfortable owning this underlying business at the strike price? Second, is my position size small enough to ensure a loss won't damage my account? Third, does the probability of success truly justify the potential downside? And fourth, what is my exact plan if the market moves sharply against me? Successful option investors do not survive because they predict the market better. They survive because they manage risk with absolute discipline and consistency. When you think like an accountant, every trade becomes a calculated business decision. If you found this helpful, subscribe to Accountant Investor for more evidence-based insights. Remember, this content is for educational purposes only and is not financial advice.